Good evening. My name is Darren McLeod. I'm the Executive Director of the New Brunswick Medical Education Foundation. We started this series a few months ago, and the idea was to bring timely, relevant topics to our donors, our friends, our supporters, and alumni on issues that could be tax-related, to charitable giving, to issues around what we do in supporting medical education. Tonight, it's with great pleasure to introduce Fraser and David Wells, Mona Lisa from RBC and Wells Wealth Management. Fraser and David have been long-time supporters and indeed investors of ours, looking after our investments for our scholarships for many, many years. They're going to focus on tonight's topic, which is tax-advantaged charitable giving. It's a relevant and rather timely topic right now, especially with people looking at gifting stock and other options, and what they can do to support their charity of choice, which we hope the foundation is one of them, and how they can actually apply that and find ways to also create savings out of it. As a bit of a background, our foundation has been in existence for 11 years. We are the only foundation in Canada dedicated to creating and maintaining scholarships for New Brunswickers in and out of province who have been accepted into medical school, with the provision that for the majority of our scholarships or bursaries, they are on a return to service agreement, which means for each year up to 4 years they receive a scholarship from us, they pledge to practice medicine in New Brunswick. Since our inception in 2010, we have given out 143 scholarships to actual individuals, 292 in total, but 143 have received scholarships from us. Well over $2 million has been invested into students from New Brunswick to come home and practice medicine or stay in the province and become our future physicians. Currently, we have 22 doctors out of that 143 working in the province in all facets of healthcare as physicians. And we have 104 on return to service, which means they're either in medical school or they're in residency with us. Last year, we gave out a record 42 scholarships worth $304,000. And this year, we're tracking to actually give out more with a higher amount. I'll have those details in a few weeks. Our scholarship deadline ended on May 31st. So we'll hopefully have some exciting news in the coming weeks. And with that, I hope you take a moment to learn a little bit about more what we do. You can certainly go to our website and contact us. That information will be at the end of the presentation. And I will turn this over to Fraser Wells.
All right. Thanks, Darren. And thanks for joining us tonight and taking some time on your Monday evenings to be here and learn a little bit about tax-advantaged charitable giving. And we'll continue to preach helping out with bottle drives and buying Girl Guide cookies. But we wanted to look at charitable giving within a tax lens. And so throughout the presentation, if there's any questions, feel free to click the raise hand button, or you can also send a chat using the chat function. So if we take a look first, and I'll just click here. Doesn't want to click for me. There we go. Okay, perfect. So just to look at what we're going to be covering today. So we'll be looking at what a charitable gift really is, personal donations within that, cash, donating securities and registered plans. We'll also look at corporate donations. So again, donating securities, and then that personal versus corporate decision, which for individuals like doctors, for example, is a common question that they have. Is it better to make a donation using your holdco or to use any personal assets that you have? So we'll look a little bit at that, and we'll also look at charitable giving using life insurance. And just throughout all this, as a disclaimer, we aren't accountants, but certainly if you did have any specific questions, we can try our best to answer them. But at the end of the day, when looking at these strategies, always best to talk with your advisor or accountant before implementing them. So when we look at really what a charitable gift is, when done properly, of course, charitable giving benefits both society and you, the donor, and it allows you to help the causes that you care about. And if we think about 2020, we actually saw overall donations for charities decline in a year where people probably needed it the most. And so hopefully we'll be able to turn around that trend. And I think, again, looking at this through a tax lens should hopefully increase those numbers a little bit. And so when we think about certain plan giving programs, you can donate cash, securities, registered plans. Of course, you can present a gift of life insurance or a deferred gift of life insurance. Are a little bit different. We'll touch on that at the end. There are other options that you can use as well, like donating personally used property like land, employee stock options, flow-through shares, but that's a little outside of the scope of what we're covering today. But first off is cash. Simplest, most widespread form of charitable giving. It might be cash given to a volunteer that comes to your door, check sent in response to a mail or a telephone campaign, or maybe it's a payment that comes from your paycheck every month. And it allows those, even with most modest means, to provide to provide support to their favorite causes. And to claim a charitable tax credit for the donation, you just have to make sure the qualified donee issues an official donation receipt for the gift that includes their CRA registration number. Of course, most charities would do that automatically. And when we just look at it within a tax lens, with the non-refundable tax credit, tax savings can actually fund close to 50% of your gift in some provinces and territories. So we'll look at New Brunswick in particular, but first on the federal side, you get a 15% tax credit on the first $200 that you donate, and then 29% thereafter. The tax credit effectively offsets any taxes owing for the year. You get a provincial tax credit that's actually added to the federal credit. And so in New Brunswick, you can see through the center, on the first $200, it's a little less than 10% that you get back in the form of a credit, and then close to 18% for amounts over that. So combined, federal and provincial, for if you're making a donation from New Brunswick, is close to 50%. So pretty powerful. And I would say if you are in the top marginal rate, which I think is about $216,000 of income or higher, any donations that you make there actually qualify you for a 33% tax credit. So even higher. And within that, we'll just look at a specific example. Let's say you make a donation of $20,000. The federal credit is, and we'll assume here that the highest tax bracket starts at $200,000, just to keep it simple. So for the amount of the donation that you're above that $200,000 threshold, you'll get a 33% tax credit, or close to $5,000. At 29%, which is what you get below, it's $1,450. Then the provincial tax credit, 18%. Again, this is a general example, but that's pretty close to New Brunswick. You're looking at a total of $10,000. So on a $20,000 donation, you're getting tax savings of $10,000. So pretty powerful, and your money can go a long way. And David, maybe if you just wanted to speak to a recent example of a client that we were talking to, just about charitable giving in general.
Well, yeah, donating securities has proven to be very, very effective. We recently onboarded a client who we talked about charitable giving in their plan, and this lady was donating about $10,000 or $11,000 a year in cash. And she had no idea of the benefits of donating securities in lieu of cash. And it went a long way to improve her tax savings. And she also had the ability to use extra cash to buy the shares that she was donating.
Yeah, and we'll talk more on that shortly. But
yeah,
if you think about the securities that you can donate, include shares of publicly traded companies, mutual funds, seg funds, government of Canada, or provincial bonds. Of course, we tend to see the first two the most for our clients that make donations, or for donations that come in, but the other two are options for those that want to donate those. So if we just take a look at an example here, just the beautiful thing about donating securities is that if you donate the securities in kind, so you gift the shares to the charity, then oftentimes you'll actually eliminate the capital gain accrued on those shares, and you get the donation tax credit. So in most cases, it actually costs less overall to make a donation of securities than a donation of cash, of course, on an after-tax basis. And so in the example on the right, we're assuming a marginal tax rate of 50% and a combined federal and provincial tax credit of 46%. So you can see over here on the right-hand side, if you were to sell shares for, call it $2,000, and donate the proceeds on an adjusted cost base, so what you paid for the shares of $1,000, you'd have a capital gain of $1,000. Taxable capital gains about $500, and the tax on that capital gain, assuming a 50% marginal rate, is about $250. So you still get that $2,000 multiplied by the 46% tax credit. You get that full credit of $920, but you do have to pay tax on the capital gain. So the total cost of the donation for a $2,000 donation is at about $1,330. Whereas if you look over here and you donate the securities directly, then there's no realized capital gain for the year. You get the full donation tax credit. So the all-in cost is closer to $1,100. So again, if we look at multiples of this, we'll take a more extreme example of a $125,000 donation, then the numbers are pretty powerful. So we'll take an example. Jack and Jill, will assume they're both in the highest tax bracket. They've got a non-registered investment account with RBC, Dominion Securities, and they want to donate their most profitable position, Royal Bank, 1,000 shares. And so we'll assume that's their full position. They paid $40 a share for these shares. They're now worth $125 a share. And so the total capital gain is $85,000, unrealized capital gain. And so with a donation of $125,000 to, we'll call it NB MedEd for example's sake, if you look at what CRA actually returns to Jack and Jill, you'll see there's a federal tax credit. We'll assume they're, again, in the highest marginal tax rate. 33% of $125,000 is $41,250. The provincial is about 18% of that $125,000. So the total donation tax credit is about $63,688. So the true cost of that donation is $61,312. So again, you're looking at getting close to 50% of that money that you donate back. And David, maybe if you wanted to speak to you touched on it earlier, but taking that money and redeploying it. And you're just muted right now, so.
Yeah, so we have a number of examples of clients that have cash and they have shares. And so take Fraser's example here. What we've found that's proven to be very effective is that the client will donate shares in whatever amount that they feel they wish to donate. And what they then do is take an equivalent dollar value of cash after the donation's been made to purchase the shares back. And what they've accomplished is two or three things. Number one, they've raised the adjusted cost on their shares. Number two, they've preserved the income stream of their investment portfolio. And they've preserved their investment balance between security and growth. And so it's a great way to preserve not only an existing account, but to get significant tax benefits for that. And maybe Darren, you can weigh in a little bit on the next slide and talk a little bit about speaking to how far this particular example can really go to help so many in our community.
Absolutely, thank you, David. We've reached, just as an example, actually, we just recently had a donation this spring from a couple who reside more than half the year in the province, who wanted to name a scholarship after very dear friends of theirs, based really on 40 years of friendship. And they thought the most probably poignant way to give back to the community, as they know and recognize the challenges, even living here not full season, access to care in the province, was to create a scholarship named after their very dear friends. That $125,000 donation, of which they received a significant tax credit from, and helped them directed their funds to a charity that they care about. And frankly, it meant it went to a charity versus then going to CRA, which I think is a good news story. That $125,000 has now turned into a $5,000 scholarship in perpetuity, which means a student for 4 years from a said region of the province will be able to tap into that scholarship if they apply to us with the criteria that's needed to apply for a scholarship with the New Brunswick Medical Education Foundation. But that scholarship will be there from now to 20 years down the road and beyond. So it's hugely significant. Medical school is a significant cost, and every bit of scholarships that we can help provide and with others to get our students to get through medical school and stay home or come home and practice, to me, is a complete win. And this is just an example. Any amount matters really to us in terms of supporting the foundation. But if you wanted to look at it from what would create a $5,000 scholarship in perpetuity, this is an example. And what the couple just did recently really will have meaningful impact for decades to come.
Oh, that's great, Darren. And Darren has told me anybody can be a philanthropist. So it can be any amount, but I think that's a great example of how far that money can go over the next number of years. So we'll take a look at an example where donating depreciated securities can make sense. Of course, this is a little bit more rare. Oftentimes, if you've got a big capital gain on the year and there's a company in the portfolio that you might not want to continue to hold, and it's trading at a loss, if you donate that, it will actually realize a capital loss that you can use to directly offset other capital gains that you would have otherwise paid tax on for the year. You do need to be mindful of the fact, though, is if you repurchase those shares that you donated at a loss within 30 days, and there's a superficial loss rule that'll effectively just negate the loss that you would have been able to claim against the gains for the year. So just something to watch out for. Again, not as common a strategy, but something that can make sense in certain situations. And then we look at RSPs and RIFs. They're a great way of saving for retirement, no question. You get a tax deduction when you contribute. The funds grow tax sheltered. You eventually have to start withdrawing them at age 72. And on the death of the first spouse, those assets roll over to the surviving spouse, no tax impact. But they are a ticking time bomb from a tax point of view when we look at next generation. So for the death of that second spouse, all of that amount in the RSP is realized as on their final tax return in the year of death. And so even for a modest RIF, that can push you right into the top marginal rate. So we can see some strategies where if you name a charity as a beneficiary of the RSP or the RIF, the proceeds are paid directly to the qualified donee, probate taxes are avoided, and you get a large credit. And on top of that, if you look at the donation of publicly traded securities inside a RIF, just as a point of interest, it doesn't matter if they're at a gain or a loss. Effectively, all that CRA is looking at is the amount donated, and that amount is treated as income inclusion, not a capital gain. So we'll look at an example. Let's take Mary, and she's a very philanthropic retiree. She wants to leave a generous charitable bequest to ensure the charity she supported all her life will receive a bequest with a minimal reduction in the inheritance for her children. And so let's assume that she's 75. She's got $500,000 in a RIF and no other sources of income at this point. And so if she were to pass away and just left the RIF to her estate, she's going to see $500,000 in taxable income, of which $230,000 is going to CRA. Another $2,500 is gone for probate, which leaves about $267,500 for the kids. So still, of course, a generous inheritance. But if she wants to include both her charitable wishes and gifting to beneficiaries, if she were to leave 50% of her RIF to charity and half to kids, then she's still going to realize $500,000 in taxable income. And she's still going to have to pay $230,000 in tax, but she's going to get a credit for, again, depending on province, about $116,000. So pretty substantial. And so what this allows her to do is allows her to leave $250,000 for charity and $136,000 residual for the kids. So of course, the kids' inheritance is being reduced by, call it $131,000. But when we look at that total after-tax bequest and inheritance, it's about $384,000. So significantly higher than it would have been otherwise. So again, not a hugely common strategy that we've seen, but I think that's mostly because people don't understand the tax impact. So something to think about as far as planned giving. There are a few limits on donations on the personal side just to watch. You don't have to claim the donation tax credit in the year that you make it. You can carry it forward for up to 5 years. You can't claim credit for donations exceeding 75% of the net income reported on your federal tax return for each year. And because it's non-refundable, let's say you had, on average, you were earning, call it $20,000 a year in income, and you make $1 million donation. Let's say you get a $500,000 credit. It's not like CRA is going to offset the $20,000 you paid in tax plus give you $480,000. Sure, you can carry that donation forward 5 years, but at the end of the day, you're leaving a lot on the table. So it's important to look at your charitable giving within the context of the income that you're realizing on an annual basis. And when we take a look at the limit in the year that you pass away, goes to 100% of your income and for the preceding year. So that's where planned giving it can make a lot of sense if you do expect to have a fairly hefty tax bill. Charitable tax credits can go a long way in offsetting that tax bill. And of course, on the corporate side, the government provides a corporation with a tax deduction, which is a little different because it reduces the taxable income in the corporation when you make that donation to a registered charity. When we look at this analysis, it's just going to be on holding companies, and the same rules apply as far as what can be donated: shares, debt, mutual funds, and so on. We'll look at an example with shares. So if we look at corporations that have large capital gains, holdco with a lot of companies at large capital gains, of which, I mean, a lot of our clients are in a situation where they might have Royal Bank at a $15 per share cost base. And it's very common for holdcos that have been around for a long time. And so when you make a donation of a security with large accrued capital gains, you actually don't face any tax, much like on the personal side, and there's a benefit to your CDA, or your capital dividend account, which I'll touch on shortly. So if we look just here, if you were to sell, let's say you want to make a $50,000 donation. If you were to sell securities and donate the cash, you'd be looking at, with a cost base of $10,000, capital gain of 40. Half of that is taxable, assuming you're at the 50% tax threshold. You're paying about $10,000 in tax. You get a deduction at 50%, so the total cost of donation moves down, and you do get $20,000 added to your CDA, which is the taxable capital gain here. And when I talk about CDA, effectively that's money that you can move out of your corporation on a tax-free basis. So the more you can do that means the less that you have to pay, in terms of other tax on the way out, if it's paying it out as an eligible dividend or a non-eligible dividend. But if you donate the securities directly, you avoid this taxable capital gain, and you add 40,000 to your CDA instead of 20. And so, of course, that's powerful in and of itself. The overall cost of your donation, by virtue of the fact that you're not paying capital gains tax at a high rate, is $25,000, or about 50% of the original donation. So it's again pretty powerful when you look at this within a corporate lens. Similar rules apply. With a personal donation, it's a tax credit, as I mentioned. Deduction is on the corporate side, equal to the fair market value of the donated securities, and therefore that reduces the taxable income and then the tax liability from there. Carry forwards 5 years, and limitation 75% of net income for tax purposes, with the exception of Quebec on the personal side. So if we look at this whole corporate versus personal decision, if you're making a cash donation, it's typically not going to make a huge difference whether it's from the corp or personal. That said, if you make a donation of publicly traded securities, it's typically preferable from a tax point of view to donate the securities with the largest accrued capital gains, regardless of whether they're held personally or through your corp. I'd say that with an asterisk, though, because if you've got a lot of money trapped inside your holdco, that eventually down the road is going to be taxed at a very high rate, and you're trying to flow as much out of your corp as possible, then if you donate using your corporation with securities that have appreciated a lot in value, then suddenly you're building up a CDA to flow money out of your corporation on a tax-free basis. So it's really situation dependent. And I'll say it again, always good to talk with your accountant. So just looking at this personal donation, again, where Jack and Jill made the donation in Jill's name and received donation tax credit of, again, close to 50% of the original donation. If we look on the corporate side, you can see we'll assume the exact same variables going into it: $85,000 capital gain. They donate the full $125,000 to charity and to NB MedEd in this case. And when you look at the value of that tax deduction in the bottom right, it's about $62,500. All the while you're adding $85,000 to the CDA. So the total cost of the donation is $62,500. So effectively half of the original donation. And the tax-free capital gain, the tax-free dividend that's you can pay out to your shareholder, whoever it might be in this case, is $85,000. If you look at this on another level and you say, if you wanted to take that $85,000 out of your corp just in absence of a donation, you'd be either paying it out in the form of a dividend that's eligible or non-eligible. So that can be between 33% and 48% of additional tax on that 85 you'd be taking out. So if that's the alternative, and we say, okay, let's multiply 33% against $85,000, which is what you'd be, withdrawing from the corporation in absence of this case, that's about $28,000. So if you add $28,000 to the $62,500, you're looking at close to $91,000 or savings of 75% on the original donation. And to the points earlier, you can take the money that you get back in the form of a tax return or cash that you had on the side and rebuy shares of Royal Bank or whatever it is to reset the cost base on the portfolio and move it up so that future beneficiaries don't have to pay as much tax. Again, everybody's situation is different. Notably with this tax deduction, sometimes it's up towards 50, sometimes it's lower. Again, talk with your accountant. So best practice, if you do intend to transfer securities, ensure you've got the account details of the financial institution that charity is managed at, dollar value of the donation. It can be approximate. You want to have a conversation with your advisor, as discussed, about which shares to donate. So you want to make sure that if you're donating shares and not rebuying those shares that you donated, how does that fit within your overall portfolio? So that's a really important piece that some people don't look enough into. You want to make sure that that balance is still in place, or at least you have a plan to create that balance again. And then a letter of authorization needs to be signed. Usually that's prepared by the advisor. And we'll take a quick look at charitable giving using life insurance, because again, this is something that a lot of people don't really understand from a tax benefit point of view. And we'll look at two strategies in particular. Number one, where you name the charity as the beneficiary of an existing policy. Number two, where you assign a new insurance contract or transfer an existing one to charity. So door number one, if we look at a beneficiary designation, effectively you're purchasing a life insurance policy on your life. You're paying the premiums and you name the charity of your choice as the beneficiary. And so there's no tax relief while you're alive and making those premium payments, but on your death, your estate will receive a pretty substantial, again, depending on the size of the policy, a pretty substantial tax credit. And so if you don't have a huge tax liability expected at death, this might not make as much sense because, again, keep in mind that 100% rule at death. You can only make a donation that offsets up to 100% of your taxable income in your year of passing and the preceding year. So if you've got a very small anticipated bill for your estate at death, then this might not be the best strategy, but there's also this strategy where effectively you're purchasing a life insurance policy on your life and you're donating it, or an existing life insurance policy, to charity. And so in either case, you're still paying the premiums, but effectively you name the charity as an irrevocable beneficiary and the owner of the policy, and they'll receive the life insurance policy proceeds once you pass away. And so you actually get a charitable receipt for all of the premium payments that you make as long as you're alive. But on death, you're not getting that big lump sum like you did in the previous example. And like I said, if you transfer a policy ownership to a charity and there's cash surrender value in it, then you might be eligible for even more tax savings there. So something to look at. Again, they can be beneficial for different situations. And we'll just look quickly at a case study. If we look at a universal life policy, and we'll assume this is in New Brunswick, we'll assume that it's just an individual policy, not joint. Initial premium of close to $40,000, in part because this is a female, age 70, and on $1 million death benefit, of course, the premiums at that point are going to be fairly high. And we'll assume a tax rate of 46.41%. So door number one, door number two. If we look at door number one, where you just appoint the charity as a beneficiary of the policy, not the owner, then you can see here, year of the policy, age of the individual, $39,805 is the insurance premium paid, and the death benefits of $1 million. So while you're alive, no credits on the premiums. But when you pass away, tax credit is $1 million, and the savings that you get from that tax credit, again, depending on situation, can be up to $463,000. So a pretty substantial pot to leave. But assuming you don't have a big estate tax bill, then assigning the contract can make sense, or you transfer ownership of the policy. And so with that, you're getting a tax credit of close to $40,000 while you're alive. And you can actually donate securities for the premium payments, which is a nice plus too. You'll get tax savings that are generated by the tax credit to the tune of $18,500 per year. And I just added cumulative tax credits over here, so you can see how over time these accumulate. And I'd say too, this isn't factoring in, once you get that tax credit back, how you can go in and rebuy shares that you might have donated if you were selling securities, or you can just take that 18,000 and reinvest it however you like. And that makes the numbers even more powerful. So it really depends on your situation, but a couple neat strategies that when we look at the long term, you can use this to achieve a lot of your goals from a philanthropy point of view. And you can really make a difference with these sorts of numbers. But again, anybody can be a philanthropist, to Darren's point. And so it doesn't matter if it's $10,000, if it's $1 million, if it's $100. With a lot of these strategies that we talked about today, you can make a difference. So at this point, be happy to open the floor to any questions if anybody has any.
Hi, it's David Marr here. Thank you for that. It's a lot of information in a short period of time. So is there a document that's available that I could read that would give me some time to sort of digest the information?
Yeah, certainly. I can follow up with Darren, and he can perhaps follow up with a copy of the PowerPoint. Would that be okay with you, Darren?
Actually, David, that would be completely fine. I'll get it from Fraser, and we'll get it off to you. We're also going to work on taking this presentation and the one previous and loading it to our website as well. And I will, when that's ready, send a link out to everybody that registered, whether they could attend tonight or not, and others beyond that, so they can actually go in and watch the video again at their leisure.
And you're right, David. It's a lot to talk about in 30 minutes. And so if you go through the materials and you have any questions, then we're more than happy to answer them.
Thanks.
No problem. All right. Any other questions? Let's check the chat box. All right.
Well,
we
what
wrap
I
it
would
up there?
suggest is, yeah, what I'd suggest is if anybody has any questions or would like to follow up later with Fraser or David or Mona Lisa, send me an email here at the foundation. It's Darren, D-A-R-R-E-N .McLeod, M-C-L-E-O-D, at nbmed.ca. That's New Brunswick Medical Education. So nbmed.ed.ca. And I'll happily forward it on. And like I said, we are going to work on loading this presentation onto our website, and we will be sending a distribution out to those who could attend and could not, and others, that it will be available. And I'm hoping that will be very, very soon. If you want to learn more about what we do as a foundation, please go to our website, which is www.nbmed.ed.ca, or feel free to call our office at 506-848-0036. And I want to thank David, Fraser, Mona Lisa for taking the time to do this tonight, and everybody who took time out of their schedules to come online and participate and watch the presentation. Thank you very much.